Have you ever seen a commercial multifamily listing online and you just weren't sure where to start in the analysis of it? Well, that's what I'm going to show you today. We are going to be focusing on a LoopNet listing and we are going to analyze it together. My name's Julia. I am one of the coaches with Commercial Property Advisors. If you haven't done so already, make sure to subscribe below. Go ahead and click that button. That will give you notifications every time that we push out new content. Additionally, if you want to learn more about what we do at Commercial Property Advisors, you can click the link below as well. That will give you information on how we do what we do, more information about our coaching program, and how it all works. All right, so let's jump into it. Today's video is a little bit of a different style than you're used to. I'm going to be sharing my screen with you so that you can see exactly what I'm looking at when I'm looking at a deal. This LoopNet deal, I picked this at random. So unless you are in Norwood, Ohio, do not use the numbers that I give you today to analyze your deal in your market. Okay, that's my disclaimer. If you're in Norwood, Ohio, congratulations. You're going to learn how to analyze a deal in your market. Okay. So this LoopNet listing, it is 11 unit building listed at 1.75 million. And as I said, in Norwood, Ohio. Okay, the first thing that you see here on a LoopNet listing is the executive summary. Now, the executive summary is a highlight reel of the property. With it being a highlight reel, it's going to show you the best side of the property, of course, as expected. Below that, we have attachments. Now, this is where we're going to focus most of our time. This is called an offering memorandum. That's what OM stands for. Before we jump into that, there's one thing that I want to show you down below. Every time I come to a LoopNet listing, I like to scroll down to the bottom and I like to look at how many days it's been on the market. So this one's been listed since July 8th. I am recording this today on August 7th. So it's been a month. Now, in this real estate environment that we're in right now, that's not extremely long, but we're pushing it. We're getting towards it being listed for quite some time. That's not a deal breaker or an overall analysis that I take into play when I'm looking at these deals. It's just good information for you to know. If the deal was listed yesterday, don't feel that you need pressure to put in an offer tomorrow. That's not how it works. We need to make sure that the numbers make sense first before we move forward. Let's go ahead and look at this offering memorandum, though, that we're going to be focusing on today. If you click on this, it brings you to a PowerPoint. All right, so the PowerPoint has photos of the property, total property overview. A couple of things I want to point out here before we dive into the numbers. First thing is this introduction page. Now, when it comes to residential real estate, you have what's called disclosures. The owner of the property is required to disclose to you any information on the property that they are knowledgeable about. Otherwise, it can end up in legalities if that seller withholds any information that they knew and you can prove it. Okay, so there's disclosures they have to tell you when there's issues on the property. Now, with commercial real estate, it runs a little bit differently. We have something called caveat emptor. Now, if you don't know what that means, we have a great video about caveat emptor that Peter Harris has put out. I encourage you to watch that. But what caveat emptor means essentially is buyer beware. So what we need to do when we're looking at a commercial real estate or commercial asset, we need to make sure that we are doing our due diligence, making sure that the information is correct. Now, a lot of that just comes with knowledge base, with having the right team behind you to help you know what is accurate and what's inaccurate. That's why there's a disclaimer in all of commercial real estate listings. It's a disclaimer basically stating that this information may or may not be accurate. It's accurate to the best of their ability. Okay. So you can't hold anybody liable. Next, what I want to focus on is the property overview. This property overview gives you a quick snapshot of the property's financials. One thing that I want to focus on here is this cash on cash return at 9.14% in year one. That sounds fantastic, but I am going to be fact checking that with you guys today. I want to see how accurate this is based on our numbers and knowledge. All right, so let's keep that number in mind, 9.14 cash on cash. Okay. Next, we're going to go down to this rent roll. So first thing I like to do on a property is I like to look at the comparison of income. Now, my rule here is looking at the gross potential versus what was actually collected. Now, your gross potential, you're going to find out from the rent roll. We'll do this together in a moment. The actual collected number is represented on the trailing 12 or the T12 for short. The trailing 12 shows you the last 12 months of income and expenses that actually occurred on the property. So we focus on the income. Now I want my gross potential and my collected number to be within a 10% variance of each other. If it's not, that usually indicates to me some sort of issue possibly on the property. But let's dive into this. On this deal, we have our rent roll looking at market rent and contract rent because I want to get gross potential rent. The number that I look at is the contract rent. Market rent is just showing you what the market solicits for that specific unit at this time. So, what that means is, for example, unit one, it's contracted under rent at $10.75 per month. It could go up to $13.75. So technically at the renewal on, it looks like March 31st of next year, you could jump up to $13.75 for this unit, but you're probably going to lose the tenant because it's hard for a tenant to afford $300 more a month. So you have to be careful on how you do rent increases like that. But its potential on this unit is $13.75 as it sits today. But what I want to look at is what it would rent for if it were 100% occupied today. So looking at contract rent, we have annualized total of $182,016. So if it were 100% occupied every day of the year, that's what it would collect. One thing to notate here is unit 11. It says it's vacant / unavailable. That's telling me that's a down unit. I don't know the reason why it's down. If I go through the executive summary, it may tell me there, but I know this is a down unit, so it's a loss of rent. So at its current condition today, if it were 100% occupied every day, 182,016. Okay, so I'm going to jot that number down here. Now, let's go and compare that, like I said, to what was collected, the actually trailing 12 number. So I'm going to go to page 26. That's our financial analysis. I'm going to zoom in on this. It's pretty small. So here's the current income. It says current income and 2023 expenses. Here's our gross potential number, the 208,260. That's the number that at market rate, what they would collect. Loss to lease means how far under market they are. So $10,344 under market. All right. So that is going to bring us down to that number that we had, the 182, which you can see here. This other number here, the non-revenue unit, that's number 11. Again, I don't know the reason, but it's a loss of rent significant, almost $16,000. So gross scheduled rent, 182,016. Now below this, they put in the other income. They say with the other income added in, their gross potential is 195,016. Then there's the vacancy. Now, this is my big, not red flag, but my big indicator that these numbers are most likely estimated. You can see here that they took a 5% of the gross potential rent, which that's industry standard. I don't fault anybody for that. We do exactly the same thing when we don't have accurate financials from a seller. So we just assume a 5% vacancy. That's what they did here. Now, when I do my comparison, like I mentioned earlier, between the gross potential versus the actual collected, and I don't want more than a 10% variance, well, the only variance here is 5%. It's telling me this right now compared to what they collected, which would be their scheduled rent less this number. It's a 5% variance. Okay. Now, if it weren't set up this way and we had to calculate it ourselves, if you get a number that is over 10%, let's say it's 15 to 18%, I start to look at, is it due to the management? Poor management's okay. We can fix that. We can change managers. Is it due to poor condition of the property? Again, we can fix that. Or is it due to the location of the property? That one I don't like so much. We can't fix the location, right? Things to notate there. So that's first, looking at income. So right now I know there's a 5% variance between the actual and the collected, quote unquote, because again, I know this is an estimated collected number. Let's focus on expenses though. So let's see what we have. Now for expenses, for this particular market, I'd say that it should run between $4,000 and $5,000 per unit for expenses on an 11 unit. Here's total operating expenses. We're at, okay, per unit, 5,618. So that's a little high. It's definitely over my high range, but let's dive a little bit deeper. There's a lot of factors that can play into that. So let's look at the repairs and maintenance. Now for this market, I would assume repairs and maintenance should be somewhere between 500 to 650 at tops. Repairs and maintenance. Okay, here we go. 496. Great. So that number looks really good to me for this market. Again, don't use these numbers in your market. That looks good. So that number looks okay. Let's keep digging though. Insurance is, I would say, between 550 and 650. And on this one, it's pretty high at 723. Now, insurance has gone up nationwide, so this is not unusual, but I would definitely be shopping insurances if this was a property that I were pursuing. Now, the next number that I look at is your property management. Property management in general is going to run you anywhere between 4 and 10% of your collected income. So that number range is solely based on the size of the property and volume. So if you have high cash flow property, you can sometimes negotiate that number down. But anywhere between 4 and 10%, you're going to be on the lower end of that range if you have a larger property or a high cash flow property, and vice versa. Larger property, you'll be on, excuse me, smaller property, you'll be on the higher end of the spectrum there, and lower income, higher end. So for this property, it looks like they put it at 7%. That sounds about right. It's actually a little bit low for an 11 unit in this market. I'd assume that this is going to be a little bit higher. So this is another number that I would be checking and shopping managers in the area to see exactly what they would charge, because for this type of property, I'd assume it'd be closer to 8 or 9%. Okay, so that number might be a little bit low. Another number that I like to look at is the taxes. Now, with taxes, I need to know, is this the current taxes or is this the future taxes? Which, of course, you have to assume these are the current taxes that they're paying. But what's interesting here is in year 1 and year 2, they also estimate that the taxes stay the same. I wouldn't agree with that, because once you purchase the property, the taxes are going to go up to some extent because the property is going to be reassessed. This number will increase. And again, it's a number that you need to find out what the mill rate is for the market or how they do the tax analysis. So it's based on either the assessment of the property, or it could be based on the sales price of the property. I really don't know. It depends on the different counties. So again, that's another big number I'd look at. Now that we've looked at the income and the expenses, in my opinion, the income is estimated. So I would want to dive deeper into that if I were under contract on this deal. The expenses, they seem accurate. Again, for this analysis, I think this 5,618 per unit is a little high, but for my own analysis, I'd leave it like that for now to analyze the numbers. Now, what do I mean by analyzing the numbers? Now I got to look at what the deal cap rate is, what the cash on cash return is, what the debt coverage ratio is. All of these numbers we can find out and we can do an analysis on in our commercial property advisors program. So what I did was I went ahead and I took these numbers, I put them into our financial analysis program to show you guys what we get for actual numbers. Now, here is what I came up with. Using their numbers for income and expenses for their actual current today, the deal cap rate is at 7.06. Now, I believe that's right where they were at. Perfect. 7.06 deal cap. Great. Now, one thing that they don't account for when they are analyzing these deals, though, is they don't account for the new loan on the property. Now, I'm making an assumption at 25% down, and I believe my interest rate I have right now a little bit higher. I have it at 7% on the loan. When I did this analysis, again, I'm playing worst case scenario. That brings us to a cash on cash return of 2.78% current. That's not great. We really don't like to see it that low. Debt coverage ratio 1.11. Again, not good. A lot of lenders want to see this at 1.25. So we're a little bit below there for lending. We may have to come more out of pocket to cover that. And then occupancy break even point at 93%. This is high. I'd rather see this closer to the 80% range. Makes me feel a little bit more comfortable about the investment. Okay, so the actual side is not very exciting. Now, this is where things get interesting, the pro forma. I used their year 1 assumption. So year 1 assumption numbers, okay? I used theirs, and what I came up with is a deal cap rate of 7.63, cash on cash of 5.08. Now, if you remember earlier in our conversation, we saw that they had a cash on cash return year 1 of 9.14. That's where you need to be careful because that's not accurate. Year 1, I'm getting 5.08. Okay, that's really low for a pro forma. That's not what I want to see. Again, your pro forma can be 5 years out, but just to fact check their 1 year, I'm getting 5.08. Okay, debt coverage ratio, we're still at 1.2, so not fantastic. Occupancy break even, it got better, 88%, but we would like to see that lower. Again, this is just year 1. Okay. Obviously, year over year, this would probably get better as you increase rent and lower expenses to the best of your ability. But some expenses we can't change. Our insurance may keep going up, our taxes will keep going up to some extent. So there are other factors that are out of our control. So this is the overall analysis of this deal. Now, if I were purchasing this deal, I would say that the property may be priced at the right price point. I don't know the market cap rate of this area offhand, but it seems like at a deal cap of 7.06, that's decent. That's probably right in line with the market. The big killer here is going to be the high expenses and not really knowing what the actual income is on this deal. Um, if the income is any lower than what we see here, you could potentially go into the negative cash flow area. And of course, you don't want to do that out the gate. Day one, you want to be making sure that the property is performing well. And if it's not, that you're prepared financially to take on that period of time that you are not collecting rent. Okay. So, this is our financial overview of a LoopNet deal. If you have any questions, please make sure to post them below. I will go ahead and get them answered for you. I hope you learned something today, and we will see you soon.